the founder of Leading Ladies Connect. Leading Ladies Connect is a community created to connect women to each other, to opportunities, and also to provide resources and amplify the voices of women. Today, we are hosting a session on like an introductory guide into angel investing in partnership with the Firehood, to bring more women into angel investing, to learn more about it, and of course, create community around that as well. Wanted to say a very big thank you to Danielle and of course the Firehood as well for hosting this very interesting part of investing, and also educating more women about angel investing as well. So just to save everyone's time, if you have a question, you can put it in the chat. We'll take some questions in between. We want the session to be as interactive as possible. So if maybe she's talking about something and you have a question, you can maybe raise your hand or use the chat box so that it's not interrupted, because the meeting is recorded. And we're looking forward to having a ball. So over to you, Danielle. And yeah.
Thank you so much. Thank you for having me. It was also wonderful to be at your one-day conference and just get to know you and see all the wonderful people you're bringing together through your network. So thank you for having me. And I love this brainchild that we have together, thinking about, well, how can we learn more about angel investing? What is it? Let's do some myth busting, right? It's not just for that TV show. And think about how can we action the thinking around angel investing, and sooner than later as well. So I felt like we had to do something to honor the Charlie's Angels. So hello, angels. And then that's where you're supposed to say hello, Charlie. Anyway.
Hello, Charlie. I was gonna mute
Thank
myself.
you. Thank you for indulging me. I really want this to be interactive, so feel free to unmute if you have questions, if you're not sure about some verbiage or language, or you just want me to stay on a particular slide for longer and think that through, because it really hits a point for you. So please feel free. This is for you. And hopefully afterwards you'll feel comfortable to reach out and connect one-on-one so we can talk more about your angel journey and what you're thinking about, because we've got lots of opportunities through the Firehood. So what is the Firehood? Why am I wearing so much orange? You know, the important questions. And so essentially we have a women's group. We started about 4 years ago now, to increase the participation, leadership, and prosperity for women in technology. So my co-founder Claudette and I, we started with a venture capital fund called Phoenix Fire. We raised over 3 million, specifically for women, and 20 million as an Archangel fund overall to deploy into the pre-seed and seed stage funds for early stage women-led startups who are raising at least $1 million. Usually that's where we participate. We look for lead investors who have generated a term sheet and written out an investment memo. So that's more on the fund side. But on the Angel Network, which is the Firehood and the representation in the ecosystem that you'll see at conferences and through our monthly events and collaborations, you'll see us represented with Firehood because it really brings the community together. And so as I was pitching to potential LPs, they were committing larger sums of capital to the fund, but individuals were saying, well, I want to get involved. I want to be an advisor. I want to be a mentor. I want to invest my own capital and learn how to do that and get exposure to the tech ecosystem. And so that's when we built out a bunch of models and offerings for how to do that. And happy to share more about what all those activities are if anyone's interested. A little bit about me personally. I've been in the tech ecosystem now for over a decade. Right out of my MBA, I founded a clean tech company. I worked on water purification for 4.5 years before selling it to a New Jersey company. So I went through the ecosystem myself as a founder, saw how many challenges there were for underrepresented founders. It was a very homogenous network at the time, and it still is in many ways. There's a lot of work to be done to diversify tech. And so I founded the first women-focused tech accelerator, Fierce Founders. And we had 100 women apply. And the winners of the pitch competition went on to raise more capital and ultimately get acquired for their companies. So they were seen as success stories in the region. And one of the things that a lot of the women said when they joined the programming was they didn't feel like what existed was for them. And so they just built it on their own. And they tried to perfect it. They tried to think through everything on their own when there were all these free resources and support systems that were in place for men and for people who were already part of the tech ecosystem. But this is federal funding. This is government funded. It's for everyone. But it was going at a rate of like 98% to all male teams. And so I became very passionate about that work. I worked for a number of funds, including the government fund, Ontario Centres of Innovation, where we're very active in pre-seed and seed stage investments. Predecessor to BKR was Dreammaker and Sandpiper out east. So through that experience, I realized that it's a long-term commitment to raise capital, just like to build a startup. And I created my own alongside my co-founder, Claudette McGowan. So that's been a really fun journey. So let me start at the very beginning. What is angel investing? So the difference between angel investing and venture capital is that you're actually investing your own money. So it's your personal savings, your personal company. Sometimes people set up a family office and you're looking to commit early stage risk capital as equity or debt into a startup. What defines that startup is up to you. It's a lot of your own personal decision making. You get to think through what companies you want to invest in, make those decisions on your own, sometimes with a group, depending on the model, and then think about, well, what can I contribute? So it's very different than investing in the stock market where you would have very little say in what the company does with your money, how the company builds. With a startup, you already know the founder, you've met them, that's why you're thinking about investing, and you can influence them in ways that could support their growth. You can make introductions, you can have subject matter expertise. Maybe you only want to invest in companies where you have that alignment, or maybe you feel like it's going to be successful with or without you, and you can take that step back and say, okay, here's my capital, but I'm not touching it. Whatever that looks like for you. But smart money refers to that support system and that extra way that you can contribute to the company. You can join as a board director or advisor. You can be active instead of just passive. Again, using that stock market example. And then you have to think about, are you accredited? So an accredited investor makes over 200K a year or 300K with their partner as a cumulative salary of the two, or has $1 million in liquid assets. There's also the $5 million illiquid assets category. So all of those things refer to you as an accredited investor. If that doesn't pertain to you, you can still self-identify, and there's new regulations to offer people who have subject matter expertise, have taken a course like what we offer at Firehood, or an MBA, or spent time in venture capital that can also accredit them as a professional. The big thing about all of that accreditation, though, is it's not regulated in the sense that you're going to be arrested for doing anything that isn't, on the good side of, taking the risk. It's more so that you're going to be able to self-accredit and take responsibility for that risk. So if the founder, if the company fails and they can't return your capital, then you'll be in a position to say, I accept that risk, I accept that loss. And you're not going to try to sue the company or say that you weren't aware of the risks. So that's really where accredited comes in. And if you have any more questions about that, happy to answer them. And it's a big market though. A lot of people are spending money and making money. Back in 2021, there were over 262 million was deployed by angels. So something to keep in mind. So why think about this? Why think about angel or seed investing? So number one, if you're making other types of investments, this can diversify the investments that you're making. So you're not all in the stock market, or you're not all in, really unrisky but not high reward, high yield shares. So thinking about high risk, high reward, this is definitely in that category. So there is unlimited upside in terms of potential for return. There's also more favorable valuations and terms in the early stages compared to VCs. So you can actually make a lot of money just from investing early on and then exiting even at the stage that VCs would invest. So you have lots of different opportunities for liquidation events. And happy to talk through these different vocabulary and language. You can also think about, well, what would motivate you? Like what matters? You know, you could have just the pure returns model, but maybe you're also thinking about socially responsible investing or impact investing or investing based on, you know, the ability to be involved in the company. So you're interested in, you could say, I want to invest 25 or 50K, but at the end of the day, maybe you don't want to um, invest unless you get that advisory role. So you can negotiate, you can speak to them, and you see what is possible. So lots of flexibility and opportunity there. You know, maybe that's rewarding and that's the experience that you want. Also regional. So most angel networks are regional. They'll be from Durham or Waterloo or Ottawa or Northern Ontario. And they're saying specifically they want to invest in regions that they can support from an economic growth standpoint and give back to their community. So they want to learn about tech. They want to learn about the ecosystem, get involved, and also have a great time. Socially engaging. You get to come to lots of networking events, meet people, like-minded people, hear incredible pitches from founders. There are worse ways to spend your evening, you know? So, and the more pitches you hear, the more comfortable you can get in terms of understanding and then also benchmarking. Was that a good pitch? Was that an average pitch? A lot of people have seen Dragon's Den and they don't necessarily see kind of the reality of what that looks like in my world, because certainly it's not that founders are coming with samples and all of those kind of bravado of a TV show. I'm usually just seeing a pitch deck that has a certain number of slides, somewhere between 12 and 20, and it follows the same kind of format and makes it really clear what the business opportunity is. So happy to dig into what you expect to see from a founder and how they pitch and what, you know, the behind the scenes reality of, you know, what a Dragon's Den deal would look like. I'm sure at Abimbola we can call it something like Phoenix Nest or Fire Founders or something fun to think about. And so as you're considering angel investing, consider that it's not going to be a one-off deal that's going to make you the money. You really have to consider it from a broader portfolio standpoint, because you want to be able to invest in at least 10 to 15 companies, given there's such high likelihood of failure for so many of these companies. Often statistics say about 9 out of 10 will fail, and that one that does succeed will get you the returns potential within the scope of that entire amount that you've invested. So that's really where the returns come in. So you want to spread out the risk. So hard to predict what's going to be successful. A minimum check size is more commonly 25K. We have a model where we can support with a syndicate of 10K checks and even sometimes 5K to see that first check go through. We can consolidate and incorporate an entity that will assume all of those checks and manage the relationship with the angels while deploying directly into the founder's company. So it's not super busy on the cap table later on. So that's one way that it's managed, and I'm also happy to talk more detail about syndicates. But you do want to set aside a certain amount of capital over time, say a span of 5 to 10 years. So you're not expecting to deploy that all right away. And sometimes it's better to sit back and even see a good one pass by and say, wow, I actually really regretted not investing in that. I can see that it's doing really well. Clearly, I'm getting access to great deals, and now is a good time. So there's lots of trigger points. I'm saying that example because that's how it felt for me, seeing some great companies go on to be successful when I knew them right when they were getting started, and I missed the opportunity to invest. So keep that in mind. Of course, there's a higher failure rate. So again, don't put all your eggs into one basket. And then the expectation is if you do create a portfolio model that you could look at the return on investment somewhere between 20 to 30%. But it takes a lot of work, a lot of investments to hit a positive return. So be prepared. And that's why it's nice to have a network of like-minded people all working together with you. So, those are some of the tangible returns, but on the kind of an intangible side, there's a lot more learning and opportunity that meets the eye than just the pure capital allocation and return. You can build lifetime relationships. It's quite an emotional journey to go through founding a company and building. So incredible founders, incredible co-investors, a lot of notoriety and recognition for angel investing. Build your network in that position could really lead you into thinking and learning about new industries and innovations. I have one angel who had an exit within a fintech, but then she wanted to pour all of her capital into clean and climate change. And she learned so quickly that she's now actually a senior partner at a VC fund focused on climate change. So she not only turned, her success in entrepreneurship from one industry into success in another industry, but she also built up her investment capabilities to the extent that she built a career around it. So there's lots of options and it's kind of choose your own adventure. But at the end of the day, what do you want to contribute to? What are you passionate about? It's a personal perspective that you need to think about. And then the more honest you are with yourself and aligned, the more likelihood for change and to contribute to that outcome. On the negative side, there are a lot of, emotions run high when people are either successful or struggling. And so there could be some interpersonal conflict or fights that come up. So usually founders and investors are on the same page about wanting to see everything succeed. And that tends to be within scope, but it's also possible that it could turn negative. And it's stressful, right? It's stressful to not know whether your money's going to come back to you, to take that risk. So those are kind of some of the things that I've noticed and happy to chat through. I think I'm seeing some comments, just taking a quick
Yeah.
look.
Okay, I was going to read that for
Yeah,
you. But maybe you're going to get to it. Somebody was asking, how do we exit as angels?
yeah,
Uh,
happy to chat about that now and answer that question, and then we can move on to the next one as well.
mhm.
So, as angels, it's the same as exits for venture capitalists. So, the typical times for an exit would be at a liquidation event. So, it's not at any point, the company is deploying this capital and using this capital. It's not sitting in their bank account. So, it's not like at any point, 2, 3 years down the line, you can say, hey, I'd like my money back now. This was fun. That's not viable or possible unless some special agreement is made with the founder or other investors who want to take your spot. For the most part, liquidation events occur when you have a subsequent funding round, and perhaps they want to buy out secondaries, when there's a merger and acquisition, when there's an IPO, any kind of you know point where they're putting up shares for sale, then you can exit your shares. You can also make that decision to exit or to stay and continue in the process. Does that answer the question?
It was asked by Modupe. Modupe, does that answer your question?
Yes, it does. Thank you, Danielle.
No
Okay.
problem. Thanks for asking.
All right. So we have one from Yelena. She says, when building a portfolio, do you usually focus on one sector you know very well, or is it better to diversify across different industries to reduce risk?
Ooh, this is a great question. Um, I'm sure there's some stats on who has had more success with exits. I would say overall, it is good to invest in what you know, that does tend to align. Just like with founders building what they know. If all of a sudden you decide tomorrow, you believe in changing the world through drones, and you've never worked with drones or been in the industry, and you start a company focused on that, it's not likely to be successful as if you were like the drone master and you're a C-suite executive who's spent 10, 20 years focusing on drones. So it's the likelihood of success. So just in the same way as founders should focus on building companies where they have subject matter expertise, it's the same value for angels. The difference is they're actually building, they're actually managing, they're actually deploying, while as you are just investing either passively or actively. So for me, I actually invest sector agnostically, but with a gender lens, because I use subject matter experts for reviews. So I'll bring in 3 experts and I'll do my due diligence because I don't expect to be an expert in any of these industries in technology. I expect to know what makes a viable company, be able to analyze whether, it's reasonable terms, whether it's a founder that I want to work with in the long term, that, you know, everything is sound and the assumptions are qualified. And then to say, based on that, is this viable within the industry, and doing that research. And that's the due diligence process. And the due diligence process can take as long as you want it to take. It can be as deep as you want it to go. There gets a saturation and plateau point. You can't just research something forever. Studies show it's about 40 hours for venture capitalists of due diligence leads to after 40 hours, you're really not really getting much more information in order to make a decision. That being said, with an angel investment, it depends on how well you know the person. So early on in a company's life cycle, you might know this person because they're a family member. You might know them because they're, an extended friend or subject matter expert that you've met in an industry. And so you know them in some ways. That's also part of the due diligence. And that's what gets people more comfortable with saying yes to someone early, because they know what they're capable of. They've seen them work and operate. They know that they deliver. They know that they're competent. They know all these things about them. So they've almost done the preemptive due diligence. So that kind of feeds into answering your question in a bit of a roundabout way and saying it is valuable to really focus on one sector that you know very well. But if you do want to diversify and reduce risk and learn and be part of things, there's absolutely methodologies to make that possible. And that's what I do. So I hope that answers your question.
Yes, it does. Thank you so much.
I think there's one more.
Okay, so that's from Leah. She says, is it advisable to fully expect your new startup business to be known and popular within the first few months of starting it?
No, I mean, there's certainly cases of that. That's something that I think we're really good at the Firehood. When we invest in a company, we make a big announcement on a stage, we get them a beta kit article, we help them close the rest of the round. So, if that kind of moment happens and they become known and popular, that's great momentum for them. That being said, to what outcome? So known and popular doesn't always lead to success. It could be distracting. It could be irrelevant popularity. What are they building? Who knows about them? Sometimes an article can be really beneficial because even if someone hasn't seen it, the founder can share it. It can give them more credibility. So I actually think about it more in terms of like a trust building exercise. And for follow-on funding, for additional clients, for hiring, for all the people that they want to bring in different capacities to support their growth, I would say a lot of companies can benefit from being more known and popular, and you can put pressure on them to do that or find ways to support them in that. And I certainly have lots of ideas and have exercised that. But at the same time, if they're building something and they have the expertise and they have the people and they have the investors, a lot of good companies that maybe have even serial entrepreneurs, so they've done it before, um, they go into stealth mode. They don't want to be known. They don't even write the name of their company. People are confused. They're like, what's going on? What are you doing next? And yeah, it's really quite quiet. So it's a case by case basis, but I hope that answers your question, and it more than just it depends.
Yes, it did.
Okay, great. All right, keep the questions coming. I want this to be engaging. I'm glad to hear that some of the pieces that I've spoken about so far are kind of instigating thoughts and questions. Just wanted to share some general stats on angel investing versus venture capital. You know, VCs they're deploying other people's capital that they've raised, so they often have a lot more capital to deploy unless you're talking about like a crazy multimillionaire billionaire that can extend from early stage entrepreneurship all the way to IPO. So there's just a very wide range of what venture capital can do, similar to angels, but overall angels will do much earlier stages because they have less capital. So as the company grows and they raise more capital, the value of, you know, $1 million check is far less significant. They're raising $100 million as it is when they're only raising $1 million. So that's why it's relevant to have a bunch of smaller checks, relevant people on your cap table for that early stage investment, but less so as you grow. And so that's a big difference. VC returns most typically come from significant exits, while as angels could look for acquisition potential. They could look for secondaries after a VC exits. So there are some returns and changes there. You can make your own personal decisions about what that looks like. You don't have to report on your capital to anyone but maybe your financial manager or your family or whomever you share a bank account with, versus venture capitalists have a fiduciary responsibility to their limited partners. VCs also invest kind of in a pooled capital, while angels are very much on their own. I think I've mentioned that a few times, so I definitely think we made that point clear. And, you know, how to lead an investment round. So the lead of investment round is typically a check that's maybe minimum 10% of the entire round, but most likely somewhere between 20 and 50% of the round. They typically invest after a lead has been secured versus being that lead unless they have a lot of experience and a larger check to write. So those are some big differences just to keep in mind. And I really like this slide. I have a few similar to it just so that you really understand the stages and the risk and the reward, right? So on the left, you see level of risk assumed is high versus low. And at the very top, you see kind of the founders are taking the largest risk. They're risking their time, their money, their soul, their lifeblood, their blood, sweat, and tears, right? Friends and family can come in early on. They're invested in the relationship. They're invested in, you know, the experience of their friend or family member. They might angel invest early on because they know them, similar to that due diligence process where it's basically like, well, you've done early due diligence because you know this person, you've seen them in action. And then you can see next that angel investors spans the most space. And that's because it's really kind of the most open season model where you can get individual high net worths who are putting their capital maybe really, really early on in the prototype stage, or maybe even at the later stages as the company is expanding, and they co-invest with venture capital or strategic investors because they are capable of writing those big checks. So there's a wide range of angel investors, lots of different people, personas, all kinds of activity. So keep that in mind. And then early on, you can see the suppliers, prizes, grants, government funding. That's because the founders need some supports to get off the ground. So angels and venture capitalists and further along, they're all looking for milestones to be hit, right? And so at the bottom, you see seed, prototype, startup, other early stages, later stage expansion, and maturity. Those are really what milestones is this company hitting? how long is it taking them to hit those milestones, and we can dig into what those milestones can look like so that you can analyze a company and determine whether it's reasonable and viable, and they've tested and proved de-risked the company. And so that's when you get to venture capital. So you can see that they're lower down, there's less risk assumed, and there's a later stage. So again, the assumption is that as time goes on, there's going to be less risk assumed. But the company has to prove that that's the reality of the business and that they've actually hit those milestones. And so that's why you also see the different stages. And so that's when venture capital will come into play. And then at the very end, you have more of the commercial banks, equity markets, and private equity coming in different capacities, of course, all of them, but they're all options for founders. And usually the startup will make that decision with the board based on relevance. It's really hard to predict early on where that exit potential could happen. Founders sometimes say, here are a few companies that could potentially acquire us as examples. That doesn't mean that's necessarily going to happen, but they can start building the relationship out pretty early. Or they can say our goal is to IPO after 10 years. And a lot of these processes are very similar in the sense that the founders have to kind of build their strategy, build their data room, build their pitch deck, and present to these different individuals. I see a few comments and questions coming in. Do you want to ask a few more questions while we're on this slide?
Okay, sure. We could take some of the questions, but some of the questions are actually very long. I'll just try to read through and probably summarize. What signals or milestones in a startup would make equity a better fit versus when debt might be the smarter path for both the founder and the investor?
Ooh, great question. So you want equity in many cases because you don't want to take on the assumption of risk. So you have someone who's on the cap table with you. They, are hoping to see that exit and that massive opportunity at the end, and they're not looking for a return anytime soon. So they're in it with the long run. They're taking the risk with you. If you don't get anything, they don't get anything. Depending on your liquidation preferences, you're good to go. While as debt, you're then assuming much more of that risk, and you're the one who then, and that they get paid off first as well and at the liquidation event. So you're going to see debts get paid off first before even other investors. And then usually the founder is last in line. So you're taking a very different assumption of risk. Some founders take on more debt than others, depending on the industry. Some VCs have quotas where they won't let a founder, they won't invest in a founder that's taken on too much debt. So I've seen that kind of cap at like 200K or 500K when a company is going towards a Series A. So if a company's taken on 500K in debt, the Series A investor may no longer invest. They might say that's too much for us. Or they'll kind of counter it and say, after your Series A, then it's recommended that you take on a mixture of equity and debt. And it just means that the founder then doesn't get diluted too much. So the company itself, they still own enough that they're motivated to see it through. They want to see that exit opportunity so that they see the upside. So that's really what a lot of the balance of equity, even for deciding on valuations, deciding on how much to raise, all comes down to is the founder, are the founders still incentivized? So that's some of the thinking around whether to take on debt and equity.
Thanks a lot, Danielle.
No problem.
Okay, so the other question here is a bit long, but I'm just trying to see if I can summarize it. Melissa, if you're able to summarize your question, it might be easier for us to answer. So I'll just wait for her to maybe shorten the question. You can go ahead, please, Danielle.
I'll just say quickly, because there's another slide that's a question that's about, what are common red flags in a pitch that usually make you walk away? So I can answer that, and then once I'm done, Melissa, maybe you can ask your question. I would say absolutely. There are some common red flags that would make me walk away. There's also a lot that, just needs some tweaking. And I think I'm more of a friendly early stage investor who offers, a bit more time. We'll send companies to different incubators where they can get mentorship and support. So realistically, if you say certain things, you can still tweak it. It's not that it's a go, no go situation. It's just, it means maybe there's some misalignment, and it could be misintended or malintended. And it's all about interpretation. Most of it is a lot of signals that the company is too early. The founder is a bit naive or green in the space, and they don't know what they mean by some of the things that they're pitching. So, for example, one thing that I get a lot is, okay, I'm excited to raise this first round. I'm like, okay, great. What's your investment strategy? And they're like, well, what would you recommend? I'm like, I'm not here to recommend an investment strategy for you. It's your company. It's your strategy. I'm looking to invest. So I want you to come prepared to me to say, this is how much we think we're valued at. This is how much we're raising. This is how much what we want to use the funds for. I want to hear those things. And so if you don't know them, then why are you coming to investors asking them what they want? So that's an indicator, not necessarily that I'm never going to invest. I'm not going to walk away. It's just that there's some strategy pieces and time that needs to be taken, and they need to get a proper advisor. I'm happy to give some initial insights, but it almost becomes like kind of conflictual around me saying, well, as an investor, I want a nice low valuation and, a good amount of a raise, but as a founder, you don't want to get diluted that much. So I want to hear the initial strategy enough to feel like we're on the same page, we're thinking about the same range of valuation, and therefore it's worth moving forward in the conversation. From a pitch deck standpoint, there's a ton of little things. If a founder says, we only need 1% of the market to be a $100 million business, to me, that's lazy math. I want to know what you actually can acquire in the market. I want to know what you're actually thinking about from your go-to-market strategy that relates to your market sizing. And I want to see the work that you put in to analyze all of that. And I want to, critique it and see if I agree with it. So when I hear just 1%, it shows me that the work hasn't been done. But always a chance to come back and show something different. Founders will create false momentum as well. So they'll say things like, we're just kicking off, you better get in early, or, it's going to be too late. And usually it's not beneficial to an investor to go in early, that it'll take maybe 3 to 6 months to raise a round. So if you don't have like a lead investor or any other interest, there's literally no incentive for an angel to come in early because they're getting the same terms as someone who's investing at the end. So usually for a founder, I would say, keep the investors warm, get them excited, generate FOMO in authentic ways. Like, we just got a new contract, we just got a new great hire, we've made headway in this way. Get them excited about the potential and opportunity of the business. Maybe ask them if they want to be part of your investor updates, and then you add them to them and they start to see those updates and they see that involvement. And it's more of a nice, warm, passive way to get them more involved until you can really seal the deal. So there's things like that where you just be yourself, be a real person, be honest, be trustworthy, believe in your business and pitch honestly. And I think those are really the things where something that would be enough to walk away is if there was like perhaps an outright lie, something that, you go to validate and then it turns out not to be true. So I've seen investors walk away from deals where they said, oh, I have this lead investor, they signed the terms, and then it turns out the terms weren't signed. So just being truly honest. I hope that answers your question. We could, that's like a never ending answer I could give for all the different things that could happen.
Okay, so we have Melissa's question now. She said she's been a SaaS company scale and get acquired with just angel funding, no VC. It makes me wonder, do we really need venture capital? Our team moves at a steady, intentional pace, and I'm not sure VC aligns with that. What are your thoughts?
So you never need venture capital. You never even need angel capital, right? So it's not like a requirement. I'm not here to sell you on those things. There's a lot of different ways of building businesses that are viable. And there's a lot of critique of both angel and venture capital investing. So, the venture capital model does this kind of massive scale, massive expectations. 9 out of 10 will fail, therefore we need you to go boom or bust. IPO does the same thing. Suddenly, all of your shareholders who own your company have different capitalist expectations of how and how fast you build your company. So you're the one in the driver's seat. You're the one deciding, hey, I'm going to take this path or that path. So from a standpoint of deciding whether you want to take venture capital, it really is about how big you think you can grow, how fast you can grow, and how much you're willing to give up. And whether it's a fight for market share in your industry, or whether it's something you can take a bit of time with to do it right. And so I think it's great that you've already secured so much support from angels. And, there's no harm in building relationships. I would say some people build too many relationships. That's the only caveat I would give to that. Like, there's no point in going to meet with private equity when you're at an earlier stage, right? Because you're not going to be speaking to them for, a couple more years at most. And then you're looking at maybe their turnover, there's different people there. So I would say build some relationships with VCs, see what you think of them, maybe find some people who are really aligned and have similar values. And if they're interested, then it's still your decision at any point whether you accept or decline their capital. Did you want to add any kind of questions to that? We're definitely sharing the slides and the recording.
Okay, so she says thank you. Okay, I guess the question was answered. So someone was asking, do you offer one-on-one consulting or coaching services to entrepreneurs capital raise?
Yes, actually, through different incubators. So I don't charge founders directly. I really want to support them, and I also am an investor, so I don't want to cause any conflicts of interest in terms of investing through my fund while receiving capital from a company who's incentivizing me. So what I do is I bring them forward to different incubators. We've got a collaboration with Venture Lab and with the Elevate Festival. So we've got programs within both of those. So those companies will pay for advisory time. And so based on a review panel and an assessment of the program, I will sometimes participate as an advisor, offer some coaching, go through the pitch decks, go through lists and lists of founders and companies that I can introduce them to, and investors especially. So the fundraising piece to say, here's some people who I think will benefit you in your network. Here are some investors who I think will participate. Happy to make warm intros. And then from there, see how those conversations go. And there might be a need for tweaking the pitch. I've had founders come back after only 10 conversations and say, everyone's saying no, and they're so frustrated, and they're like, this isn't for me. I'm like, 10 isn't enough. You've got to see 100. And then she ended up being incredibly successful and really aligned to her investors. So it does take that time, and it's great to have some, advisors who work in the field, but it's also good to have other founders who, are on kind of your same stage, or maybe 6 months ahead of you is really nice, because then they can advise you back and say, okay, I just accomplished this. This is what I did. That's usually the best advice. So that's why I say I intro founders to each other so much. But thank you for the question. And this time has gone by so fast. I'm going to just get through maybe a few slides, and then we can have the final 10 minutes for additional questions?
Yes, please go ahead.
Yeah. So this is another slide, and if you look at this one, and this one, you can see the similarities in terms of the left-hand side being more about risk, and then the bottom being more about stage. So then you see on this one, you've got stage at the top, right? Investigation, feasibility, development, intro, growth, maturity. So some words are the same, some are different. And then you have time and profit. So this one's an indicator of kind of what revenue generation and what stages and milestones. So remember how we were talking about milestones and what companies need to accomplish to be considered pre-seed, seed, Series A, Series B. And you can see the amounts that they need to raise. So then you could say, I can invest, as a friend or family or a founder, you could invest as little as 1K. Like a founder could put $1,000 into their bank account and be that first investor, right? And then you're getting into pre-seed and maybe they're writing 10K checks. And I really want to talk to anyone who's interested in angel investing afterwards about that 10K check and seeing if anyone wants to participate and do some activities to learn, because you learn best by doing in this industry. And then once you're getting into seed and startup, then you're thinking about 25K checks to over $1 million even. Series A is in that 2 to 5 million, and Series B and beyond are massive checks. As well as then maturity. And so then you can see again, similar to the last slide where you have the government sources, friends and family in the earliest stages, angel investors across the board, overlapping with venture capital, and then IPO and banks in the later stages. And then here, once again, you have kind of the average time, so 8 to 10 years. So you have the stages from ideation to exit, kind of informing that. And then it goes up in terms of, hitting more of those milestones. What does that look like? So again, I did 3 different versions of this. I could even find 10 more, but I think you get the gist of what this is representative of, how you can envision yourself in comparison to the stage of companies, the milestones they're expecting, the language that's used, the different language that's used as well, right? That there's variation. Seems like, maturity and the exit are kind of at that end. And then you get this pre-seed, the beta, the early proofs of concept and customer problem fit and investigation and seed and prototype, right? So now when you hear these words, you can almost envision your own diagram like this and say, okay, this is within the realm of an angel investment. Whereas if they're suddenly talking about massive multi-million dollars and Series B, then you might say, oh, this one's already, past my scope of potential for investment, but I know someone who might be interested and I can help them out, right? Or you think, wow, you just came up with this idea yesterday. That's way too early ideation for me. I don't even know you. So I'm going to wait a year or two until you're raising a true round of 500 to $1.5 million, and you're accepting 10, 25K checks from angels. And then I'll see, what have you accomplished? Have you hit the right milestones? You really have to analyze those pieces, because even sometimes I think, okay, great, this company is doing well. I really like what they're pitching. They've got a bunch of other investors over the line. And then from a lead standpoint, I read their memo and I look at what milestones have actually been hit, not just theorized, and it's way too early. And it's more like a pre-seed round. It's not a proper seed round where I want to put in my venture capital fund capital. So those are some things where you always have to do your own due diligence. You always trust your instincts, trust your brain, think things through. If it seems too good to be true, it probably is. But feel free to validate. And if the founder is putting pressure on you or making you uncomfortable or saying now or never kind of things, then, don't let that sway you. Stand firm, feel comfortable with what you're doing. And you can always say no. No one's, the money shouldn't be burning a hole in your pocket. It should be, a founder should feel like a vehement yes. Like you must be so ready and so excited and so much like FOMO that you're like, I don't want to miss out on this. I'll regret it more if I don't invest. If it's kind of a neutral and you're like, well, I said I wanted to be an angel and I'm kind of interested, so this one seems fine. I can't really poke holes in it. That's no one is forcing you to do this. If that's not good enough, then wait until you do meet that company that makes it worthwhile for you. That would be my advice. I can keep going. I have obviously endless slides. I think this is also a good place to kind of end around thinking about, well, what does this look like? So a founder comes to you and they're saying, hey, I'd love for you to invest. I heard you're interested in angel investing. Well, what do next steps look like? How do you manage that process of engaging with that founder? And so it all starts with deal flow. And that's one thing that the Firehood's really great at, where we have just tons and tons of companies pitching us all the time. So we'll go to a conference like Elevate and we'll hear over 100 pitches. And it's like, what stood out to you, right? And again, this is trusting your instincts and thinking it through. What stood out to you? Where do you find opportunities? What does that look like? And you can do some quick evaluation, quick screening. You know, if they have some competitor slides, you can do a quick research on the competitors and say, does this make sense? Did they analyze this effectively? Is everything adding up? They mentioned these people, look them up. Oh, you're connected to them. Maybe you can reach out, ask them a few questions. You're already starting the due diligence process. But that's like a kind of a quick screen, essentially. And then you're looking at the due diligence process. You're looking at a deep dive into the team. Maybe you want their resumes. You want to get a reference. You want to learn more about them and get to know them. Maybe you want to analyze and figure out whether the market and the numbers that they're projecting make sense. What are their assumptions? Is this reality? Does this sound really good and you were really charmed in the beginning and then it's starting to weaken as you look at what's really going on? If it's a small market, then it's not going to be, you know, a big potential exit. So is that really where you want to take your risk in this field? And then looking at the terms, do they make sense? Are they aligned? If everything else seems great and then all of a sudden they've got a wonky, super high valuation, that could make you question whether, you know, this company has a realistic sense of what they're looking at. And it's not only just about you, it's about the next round where investors are coming in and potentially not wanting to invest at that valuation. Maybe they'll lower it. And then you, as the earlier investor, took a risk at this stage, but maybe they have a down round because no one else will accept that valuation. And so not only did you put in capital earlier on, and then they raise more capital, you're actually looking at a loss. So, I mean, the company's still alive, it's still growing, that could grow again, but that downtick is not an ideal scenario. So that's why you want to be careful. The founders need to be careful. There's a really funny clip from Silicon Valley as a show on a down round and avoiding that and taking too much cash and struggling in those ways. So you want to make sure that everything's aligned and you have some benchmarks in your head of what you're comfortable with. And that's a whole other session on valuations and terms. And then thinking about, okay, yes, let's move forward with this deal. But what does that look like? What post-investment support can you offer? How do you get involved? How do you stay away? What kind of things happen? And yeah, that's why I call it kind of support without smothering, because it can take away from the business if, you know, people want to have a board meeting every other week, then they're preparing those documents. And I've seen that activity that happen sometimes when everyone's too excited about a company and they invest too much of their own time. So just think about all these things. I feel like now you're equipped to say, I can go have that first meeting with the founder, I can ask some questions, I can understand some of the language, I can know essentially what will work. And you also know that you know Abimbola and I, and you can reach out if something's happening and you're actually taking those steps. And you can also reach out to us to do more. If this was helpful and valuable for you, then happy to kind of continue the learning journey with you and action this in different ways, even as an event. So with that, I'll stop sharing. We do have the recording and we have the slides, so happy to do all of that.
Thank you so much, Danielle. And thank you everyone for joining. I hope you found the session very helpful. Yes, we'll share the slides with our community members. I put the link in the chat. If you want to become a member, you can sign up. And I think we're going to have like a series with this because, of course, we can't talk about angel investing in 1 hour. I also know that we have some programming that we're working on, like, of course, getting capital ready, or you being on the other side as an investor, how to spot like good companies, ideas on how you can get started on your investment journey. But I know we have one question that I know that would be the question on the heart of most of people on the session, and that would be like, how much money do you need to start
Oh,
this journey?
yeah. I mean, that's why it's kind of a range. Typically in angel networks across Ontario, and you can check out Angel Investors Ontario's website to see all the different groups, because if you're based, outside of Toronto and you want to be investing in Durham, or you want to be investing in Waterloo or London or Burlington, there's different angel groups that can really help you out. They tend to have a minimum check size of 25K. We have a minimum check size of 10K. We have had a few 5K checks here and there, especially for our syndicates. So we do have some of those available so that the founder isn't managing all of the paperwork and what you call back and forth with an individual for a smaller check. And also their cap table stays clean when they raise more capital. So those are some reasons why the check sizes need to be that size. Women's Equity Lab will take 5K checks, and they always do syndicates. They ask a lot of questions. We tend to get different deal flow as well. So there's a wide range of where, at the end of the day, how much and what terms don't matter as much as, is it a good deal? Are you actually going to get a good return? Is this actually, potentially a unicorn that you've got? And how do you access that? So I really go along the philosophy of, let's get this base level information and education covered, similar to what you're looking to do for your series at Abimbola, and then think about from there how to find the deals. And finding those deals is the hardest part of the job.
Yeah. All right. Thank you so much, Danielle. I know we'll probably come back for part two very soon. I want to say thank you so much to everyone. And everyone is really, I can see some comments here, totally worth it. It's very great and insightful. Yelena says, thank you so much. Juliet, thank you. Thanks a lot. Well, thank you guys so much. I would advise that, stay connected to us in our community. When we have the next sessions coming up, if you have any questions for Danielle, you can always reach out to her on LinkedIn, and we'll share the information about the session with you. You can also maybe reach out to her via email as well. I know somebody had asked about, getting a one-on-one with her. So we can also make that happen as well. Well, in closing, Danielle, do you have any other final words before we say good night, everyone?
Yeah. I had the Charlie's Angels, angels in action. I would say don't be shy, don't be nervous. It does feel, it's kind of like, bungee jumping, where you're taking that risk and trying to decide whether to do something. And so, just start is half of the battle, right? Just starting, feeling more comfortable with the process, testing it out. 5, 10K can sometimes be similar to what you would spend on professional development. And you really do learn a lot through this process. You learn about startups, you learn about yourself, you learn about network, and your network is your net worth. So I really just enjoy the energy and the ideas from entrepreneurs. That's what motivates me. But think about it, reflect on, what do you want to get out of this? What is your personal thesis? What can you contribute to founders? And as you think that through, we're here to support you.
Thank you. Thank you all, ladies, and I hope you enjoyed the rest of your evening. Take care.
Great way to
Bye.
spend Thursday night. All right. Cheers. Thank you so much.
No problem.